let's get to it here. Tim Quas, what happened? We were waiting for option expiration. Did we get a turn, Tim?
I don't know, but I want to know what the name of that algo is that is
picks
hammering
me off all the time.
Right, that's hammering Dennis.
I think it's Citadel.
Hey, Tim, before you get deep into the woods here, one of my son-in-law's friends listens to the show consistently, and he loved our little Marlboro Man segment last week.
The Cowboy Killers.
Cowboy Killer.
I should come on with a mustache
and a 500-gallon hat.
big hat. Well,
all right, Tim.
So, Mitch, to answer your question,
yeah.
We're only halfway through. There's the expirations period, and then there's the renewal. And I always tell folks that you have to take into account all of those things. So what we're halfway through, aside from apparent banking crisis, what we're halfway through is the March options expirations and then the renewal of the April series. So Thursday index options expired, AM dated index options. Friday was there are all kinds of things going on. 6,000 plus weekly and quarterly options expired. S&P indexes rebalanced. Then today, our new options, the whole new series trades. And then Tuesday is what we call Counterparty Tuesday. That's when, so the banks, who are generally going to make markets in these things, will square the books. And then Wednesday, as Jay Powell announces whatever he's going to announce, the volatility as an asset class expires. We think of it as VIX expirations, but it's a lot more than that. So really Thursday is when we get a read on the condition of the market. That's really it. Everything in between will have some very short-term self-interest in the form of derivatives. Are there people buying them, selling them? Are you buying or selling volatility? Do you have exposure? Are you hedged? All that stuff has to sort out. And it can be very difficult to trade well during those times because you don't know what's going to happen and you can only see half of it. Remember, the options market, half of it's over the counter. So you can see the exchange traded components of it, but it doesn't really give you a full read. So traders, that's why it's very important. If you're risk intolerant, you should be aware of this. If you have trouble sleeping because of what your trading positions are doing, you should look at the options expirations calendar. You can go to the Options Clearing Corp and see it. We have it too. If you go to marketstructureedge.com and you look under resources, you'll see the expirations calendar. But that's something to keep in mind. If you have a difficult time, just skip it. It doesn't, as we talk about all the time on this show, it doesn't matter what you pay for something. It's whether you can sell it for a better price. And it doesn't really matter when. We're all going to own the same things. And so you have to be aware that when you buy and sell things is very important. I was looking at this data over the weekend, which that's what I do. I sit around studying data. But if you look at on
the slopes.
Smoking a Marlboro.
It's
smoking a Marlboro on the slope with his laptop looking at data.
He's the guy in the chairlift that puts the smoke out, on his hand.
I did have a 20-minute phone conversation at the top of Mount Werner on Friday morning as I was skiing. I skied 17,000 vertical feet on Friday, but I was up at 10,600 feet, and it's a pretty good spot to conduct your affairs. I mean, it's amazing.
That's where all the business happens, right? Now, right. Of course. So, we're halfway through this stretch here. Yeah. We've lost two major banks. There's uncertainty pretty much everywhere in the world. What's next, Tim?
Well, let's look at the data. And just to finish that data thought, this is an important thing for folks to know too, I think. There are 30, what I was looking at was the construction of the Wilshire 5000 index. And the reason I do is because it's supposedly the most complete market index. And there are 3,525 components in it. So that's how many public companies there are. What's fascinating is this, that 1,700 of them, half of them are microcaps that are less than 1% of market cap. They're like 50 basis points of market cap in 1,700 stocks. So 95, close to 95% of market cap is in less than 800 stocks. There are, call it 480 large caps, roughly the same, 290 mid caps. Those are the ones that everybody owns. All of the money is concentrated into this small set of stocks. The largest single asset class on the planet now is what's called passive large cap blend. That is large cap value and growth. That's where all the money is. And it's a great lead in, Mitch, to your question about the banks, because there is concentration risk. Coming out of 2008, we have significantly fewer banks and more concentration than we had before. It was interesting. I was listening to the former CEO of Barclays. Barclays bought Lehman, you'll remember. And he said, that was a good deal. We made $10 billion in returns the first year owning Lehman. And the crisis in 2008 was related to commercial real estate and residential real estate. It was real estate focused. And he said the 4 largest banks in the United States have 60% of all deposits. So that's very interesting. There is concentration. That was the problem for Silicon Valley Bank. There was a concentration of deposits there. Here's the thing: as we get to data and what to expect, what do the data tell us? Because that's the only thing you can go to me. Because the market will tell you what everybody thinks. The beautiful thing about the stock market is it is a mechanism that reflects every motivation: fear, greed, algorithms, human thought, asset allocation, stock picking, hedging. It's all in there. And so you can look at the supply-demand balance and see what everybody's thinking. Which way is it tipping? But here's the thing to me: what this crisis is about is it's not real estate. This crisis is about our debt. This is about our debt as countries and governments. Realize that Tier 1 capital, which basically all banks have to carry, the Basel Accords. There are 3 different versions of what are called the Basel Accords. Switzerland is the author of banking. It began there. The Medicis made it great in Italy, but it came out of Switzerland. Switzerland is known for banking. And the Basel Accords require banks to carry tier 1 capital. Our own Dodd-Frank legislation in the United States, and Dennis, in Canada, there's something very similar. The banks have to carry our debt. What is called safe assets is U.S. debt. Really, it's government securities and mortgage-backed securities. And everybody owns it. Silicon Valley Bank owned the very same mix of assets that the Federal Reserve does. But the Federal Reserve is leveraged 200 to 1. Silicon Valley Bank was maybe 20, like a tenth of the leverage. And so what is really coming due for us is our overspending as a people. So I don't know where it's going to go, but let's look at the data. Because
that's a bigger problem, though. Like, you're opening a whole can of worms here, and it is the overspending of everything: governments, people, consumption. Not saving for a rainy day anymore, but spend now because YOLO, you only live once. Yep. I mean, the whole mentality of the world, especially through COVID, has changed here, Tim. Yep. And I mean, eventually, people like Peter Schiff have been calling this to end, for the better part of 20 years here now. Peter Schiff wrote a book about it back in 2006. And obviously 2008, everybody, was feeling that Peter Schiff, figured it all out. But then they ended up just kicking the can further down the road. Does all this eventually come to roost, or do we just keep, digging the hole deeper, more debt, print more money eventually? We're going to have a banking crisis. Well, let's throw money at the problem here, and the party just continues? Or is there a reckoning day?
Well, I will use one of my favorite lines, which I've used here on Market Structure Monday several times in the past, and it's from Herb Stein, who's the father of Ben Stein. Ben Stein from Ferris Bueller's Day Off. Anyone, the teacher,
Bueller,
right? So
Bueller.
Right, Bueller, exactly. So Herb Stein said famously, if something, and he's an economist, if something cannot last forever, it will stop. So it's a funny line, but it's true. Yes, at some point it will stop. We have been very successful in engineering our capacity to overspend, to spend more than we make. My dad taught me a 5-word economic lesson when he sent me off to college. He said, spend less than you make. That if you do that, then that is infinitely sustainable. Nothing need ever stop. But when you spend more than you make, at some point there will be a reckoning. And it has been the history of the world since the United States left the gold standard in 1971, which is a good lead-in, right? I mean, that's really what it's coming down to. It will ultimately be a currency failure. I don't sit around worrying about this, but I think one should understand what is occurring. If we don't have a basic...
Ben Stein was also the principal on the Wonder Years.
You're exactly right, and he did a great job there. By the way, this is Foot Locker. So we went
on a little tangent.
So there's no gold in Fort Knox. Is that what you're telling me, Tim?
Well, it's really interesting, yes, because here's the interesting thing is in momentum. They're in this momentum portfolio. So what we do for Edge users, and so if you haven't seen this, it's the dashboard at Market Structure Edge, platform designed to say, let's take all of those infinite inputs and boil them down to 4 things that motivate buying and selling. Story. It's less than 10% of volume. It's stock picking. This is stock picking, by the way. This is out of the Investment Company Institute's fact book. They put out a fact book every year. And if you're a data geek, you should look at it because it tells you the trends. This is stock picking. And this is indexes and ETFs. Which thing is getting owned? Stock picking. So you can't look at the market traders every day and say, whoa, it's rational thought that's responsible. Rational thought has been in steep decline for 15 years. It's not the thing responsible. It's asset allocation. Okay, you have to get that. All have to get that through our heads. In momentum, so momentum just looks at the math and says, where is there steep, strong supply-demand divergence across the market in liquid stocks? Now, I could look at crypto stocks, but they're not liquid. I have a crypto portfolio, and we could talk about that because the 2 best performing asset classes currently are Bitcoin and gold. Right? So here's momentum. It's got 4 in it. And the lead sector is materials. And if you go into it and look at it, say, well, where is their supply-demand divergence? 2 of the 4 are gold stocks. That has never happened before that I'm aware of. And they're very liquid stock. Gold, for trade 46 million shares daily, 30 billion of market cap. AUI is another gold stock, Yamana Gold, and trades 34 million shares a day, but only 5.5 billion of market cap, so barely into the Russell 1000. But that's very telling. We have in all the years running this data, both experimentally and on the platform now for a little over 2 years, that's never happened. So that's telling. What does it tell us? Well, it tells us that this is a serious event. It really is. Maybe we should beware that there's the possibility that this becomes worse because all of the inputs are saying, well, gold and Bitcoin, things that are shelters supposedly from storms, are the places to be. Note that Intel's in here too. And Illumina's got, an activist battle going on, but those are the 4 stocks out of the 3,525 stocks comprising the Wilshire 5,000 that show the kind of supply-demand divergence that would be appealing. So it's not very good. Mitch, if we looked at the data, broad market sentiment on a 10-point scale is 3.7. For the market to consistently rise, that number must remain above about 5.5. So clearly that's not very good. If we click through it and look at the supply-demand balance in the S&P 500, and the way this works, folks, so demand is an algorithm that takes those 4 reasons: story, characteristics, I didn't finish them, price, and derivatives. Those are the 4 pursuits in the market. And if you put them all together, you can measure the effect on prices. And if the number is above 5, so if it sits between the green line and the red line, that's really good. That's where the market's healthy. And where is it now? Well, it had this very weak top here and it's falling. Supply is short volume, not short interest, but short volume, borrowed stock. Well, the market is very dependent on credit, just like the whole planet. And look at this. The supply side is well above trend. It's 51.3% of all trading volume. Weak demand, high supply. What happens to the market? Well, as a general rule, it goes down. And there are things you can trade things in this environment. You can trade momentum and you can trade low volatility, but you cannot expect the broad measures to do well unless something changes. This is going to have to get stronger, and it might. By Thursday, it would be very important. Will this improve? Will the supply side come down and the demand side pick up? If so, we will have a good March into April. I don't know. We're going to find out. But at present, these are not great data. You could look all across, look at communication services, rising supply, falling demand. Demand's actually bottomed. Consumer discretionary, not very good. Consumer staples, not very good. Look how high the supply side is in all of these. Yeah. So you would be short the market more than long the market right now.
Yeah, it doesn't seem like there's much opportunity, at least from there on the long side. But like always, we got to look deeper into the hood. I'm sure there's different sectors that we didn't get into today. But you guys can check out Market Structure Edge for yourself. You guys want to take a look at this data? Go ahead and check it out. Market Structure Edge. Get your free trial today. And like always, reach out to Tim if you guys want to learn a little bit more on how to use it, right? You guys see the way that Tim goes about it. If you want to reach out to him, he'll definitely go through it. And they also have webinars, I think, every week, Tim?
Thursday, 2:30 p.m. Eastern time. I lead them. They're very,
there you go.
We got smart users, and they're very vigorous, interactive discussions. So come join one.
Hey, well, like always, you guys check out Market Structure Edge. We'll have you back on, Tim. Always good to talk to you.
Have a good week, guys. Thank you.